All right, let's jump right into this explainer. Today, we're slicing through the noise to look at the highly technical, multi-layered mechanics of disaster casualty losses and statutory tax relief. We aren't just doing surface-level storytelling here. We're breaking down the strict, mathematical cause and effect sequences you actually need to navigate the tax code when disaster strikes. The authorities aren't exactly known for their leniency, so understanding exactly how these rules apply is absolutely critical.
So here's our roadmap for today. We're going to start with jurisdictional classifications, move through the mechanics of casualty losses and valuation methods, examine tax exclusions, outline strategic timing, and then finally, wrap up with documentation. First up, jurisdictional classifications, specifically looking at federal versus state triggers.
Right off the bat, we've got to make a massive distinction. Administrative relief simply grants you a logistical pause. Time extensions for paperwork and payments. Tax relief, on the other hand, unlocks actual financial deductions. According to expert analysis, a really common and incredibly costly assumption is that an administrative extension automatically guarantees you a financial deduction. It absolutely doesn't. The geographic scope and the specific type of government declaration strictly dictate your eligibility. Assuming otherwise, well, that's just a fast track to a denied claim.
Okay, before we even touch a calculator, the event itself has to be categorized correctly. A casualty isn't just any random damage. It must meet this totally rigid foundational threshold. The event has to be sudden, unexpected, and unusual. Sudden means rapid, like a lightning strike, not progressive deterioration. Unexpected means unforeseeable, and unusual means it's not a day-to-day thing. So, progressive stuff, like slowed termite damage or a rusting pipe over several years, doesn't count. If the damage misses even one of these three criteria, the strict rules of casualty loss are literally off the table.
Moving on to the mechanics of casualty losses, focusing on the strict mathematical sequence.
Now, this is where things get incredibly rigid. You absolutely must follow these exact chronological steps to filter your gross loss down to your legally deductible loss. Every single step acts as a mathematical filter explicitly designed to reduce the total allowable relief. You can't skip around. The tax code demands strict adherence to this sequence. First, you identify the lesser of your property's adjusted cost basis or the actual drop in its fair market value. Second, subtract any insurance compensation you've received or even reasonably expect to receive. Third, you apply a strict per-event statutory dollar floor. And finally, apply a percentage limitation based on your income. It's essentially a punishing gauntlet of subtraction.
Let's put that into perspective and think about what that actually means. A standard loss must exceed 10% of your adjusted gross income just to qualify for a deduction. So if your calculated loss, after all those other deductions and insurance payouts, doesn't breach that massive 10% wall, your statutory deduction is a hard zero. It is an incredibly high bar to clear. For a lot of people, this is exactly where the math abruptly ends.
But hey, context completely rewrites the math here. Recent legislative acts have temporarily created entirely distinct rule sets. A standard casualty loss enforces that strict 10% limit, but if your loss falls under a formally declared qualified disaster loss within specific statutory dates, that massive 10% wall is often completely waived, though the initial per-event floor might be slightly adjusted. This non-obvious detail means your final financial outcome is entirely dependent on timing and government classification.
All right, let's look at safe harbor valuation methods, or basically how to bypass those highly complex appraisals. Federal authorities have actually built in these alternative pathways, safe harbors, to establish the drop in fair market value for real property without you having to hire a super expensive appraiser. You've got the de minimis method for minor losses under a specific statutory dollar limit. You have the insurance method, which relies strictly on your carrier's estimated loss reports. The contractor method requires a formal binding contract for repairs to establish the value drop. And finally, you can use appraisals generated for federal disaster loans. Using these safe harbors drastically simplifies the burden of proof, provided you meet their specific rigid criteria. But what about all the stuff inside your house? For personal belongings, there are two strictly defined pathways you must use if you're going the safe harbor route. The declining value method allows for a good faith, written estimate of the value drop, but it's strictly capped at a pretty low dollar threshold. For more substantial losses, you use the replacement cost method. Now, this one is highly analytical. You take the current cost to replace the item, and legally, you must mathematically reduce that value by 10% for every single year you've owned it. It completely removes emotion from the valuation and replaces it with a hard, unforgiving depreciation formula. So that expensive couch you bought 5 years ago, yeah, it literally just lost half its deductible value on paper.
Let's pivot to tax exclusions for relief. This is all about protecting that incoming capital.
When those relief funds finally hit your account, you have to protect that capital. Disbursements for temporary living expenses, grants to rehabilitate your home, need-based government assistance, or even bulk insurance payouts for unscheduled personal property, these are explicitly excluded from your gross income. The systemic intent here is totally clear. The goal is to restore you to your baseline, not to penalize your recovery with a fresh new tax bill. If the government throws you a lifeline, they aren't going to tax you on the rope. But listen, there's a massive trap hidden here regarding implicit assumptions. You absolutely cannot double dip. If you receive a tax-free grant and use it to repair your roof, you cannot also claim that roof repair as a casualty loss deduction. The mathematical formula ensures that every single dollar of tax-free relief you receive proportionally reduces the tax deduction you're allowed to claim. It is a strictly balanced equation.
Next up is strategic timing and elections. Let's talk about the preceding year rule.
This right here is a totally game-changing, actionable insight. The default mechanism forces you to wait until the end of the year the disaster actually occurred to claim your loss. But the preceding year election allows you to amend your tax filing for the year immediately prior to the disaster. By retroactively applying the loss, you lower your past tax burden and potentially generate an immediate, expedited refund exactly when you need the cash flow the most to rebuild. But, and this is a huge but, this acceleration tool is heavily restricted. Remember, state-level declarations alone, unless specifically approved by top federal authorities under new legislative frameworks, generally cannot utilize this accelerated timeline. The geographic and legal boundaries of the formal federal-level disaster declaration absolutely dictate your strategic options here.
Finally, let's cover documentation and procedural forms. It's time to establish the proof.
Look, if you don't take a ridiculously aggressive, proactive approach to gathering precise documentation, these statutory relief mechanisms are completely useless. You need continuous, unedited video walkthroughs of your property before a disaster ever strikes. You need the original purchase documents to prove your cost basis. You need formal insurance reports and binding contractor estimates. The authorities require absolute, undeniable substantiation. If you can't prove your baseline, your mathematical calculation is basically treated as a zero.
And here's a non-obvious detail that's absolutely crucial. Claiming this loss fundamentally alters your property's mathematical baseline for the future. When you take a deduction or receive an insurance payout, your property's legal cost basis drops. Then, when you spend money to permanently rebuild, that basis goes back up. It's this continuous living mathematical formula that will absolutely impact your capital gains taxes whenever you eventually decide to sell the property. A disaster today will quite literally reverberate through your tax returns for decades.
So that leaves us with a pretty heavy question about preparedness and the burden of absolute proof. We've gone over the strict mathematical sequences, the rigid safe harbors, and the precise timing required. But all of this entirely relies on knowing exactly where you started. So ask yourself, without comprehensive, time-stamped documentation of your property's pre-disaster condition right now, how on earth will you substantiate the mathematical baseline required to unlock this statutory tax relief? something to think about. Thanks for diving into this explainer with me.